Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Brian Daingerfield, who is our US head of G10 FX. And Brian, who is your markets that were causing all the havoc this week. We had a big move in dollar yen, finally traded above 150, and within seconds was trading all the way down at 147.13. Smells a lot like FX intervention to me. Brian, what actually happened?
So as you mentioned, Eimear, it was the yen that was probably the most interesting currency this week. And just to set the stage, dollar yen has been moving higher pretty steadily over the last couple of months. You know, the dollar has been rallying against a broad array of currencies, and the yen is among them. And that move, I think, has been inspired really by relative interest rates. As we know, the Bank of Japan has been among the most dovish central banks in the world, keeping their ultra easy monetary policy in place, taking action to try and defend their flexible yield curve control regime. The Bank of Japan continued to keep that dovish stance more or less intact at their late September meeting. Meanwhile, you've seen upside pressure on the dollar continuing as yields continue to rise, particularly longer dated yields in the US have been rising. And so dollar yen has been moving higher slowly but steadily. Well, maybe slowly is not the right word, but in what I would consider an orderly, not particularly volatile way. It has been ticking higher, and it was approaching a key psychological level that I think a lot in the market were focused on, this 150 level. 150 in dollar yen was a level that I think the market was very closely watching. And we know that intervention activity by the Bank of Japan took place at this time last year at similar levels. We saw intervention levels actually earlier in the run-up in dollar yen last year, closer to 146. But the 150 level we know was a focus in the market. So what happened on Tuesday, as we're recording on Thursday morning? On Tuesday, just after 10 a.m. New York, we had a very strong reading in the US coming from the job openings and labor turnover survey, the JOLT survey, that came in higher than expected. Market very much looking at economic resilience in the US, strong data from the labor market as one of the factors that's been driving stronger dollar and higher yields. And as that data came out, the dollar rallied against a number of currencies, including against the yen, and that pushed dollar yen briefly above this 150 level that we know the market is watching closely. And as you mentioned, Eimear, very quickly after that, we saw a big drop in the exchange rate that may be consistent with intervention. And so the move, was it actually intervention, or was it simply just a rate check from the Bank of Japan with a couple of days of hindsight to look back at the move? If you compare the move that we saw in dollar yen lower in the instance after, in this instance, if you compare that to the intervention period that we know, confirmed intervention, from the Ministry of Finance, Bank of Japan back in 2022, the scale of the move was not nearly as large. And from a volume perspective, I think it's also clear that the volumes in dollar yen were not as high in this instance as they were during intervention periods last year. So I think with a bit of hindsight, it looks like this may not have been actual intervention. It may instead have been the Bank of Japan coming into the market and seeing what the levels would be in the preparation for intervention. So that was certainly the intrigue this week, was Bank of Japan potentially coming into the market, intervening to try and stem the decline in the yen.
Okay, so it may have just been the market getting a little bit ahead of itself, especially as you said, that 150 level is really key psychological level for dollar yen. And I mean, you talk about, kind of intervention that we saw last year. What are kind of the main kind of contrasting differences or the similarities you were seeing against this period?
Yeah, so I think there are a lot of similarities between where we were at this time last year and where we are now. A lot of the themes that were dominant at the time have sort of come back in a way, maybe in some cases smaller and other cases larger. You think about some of the drivers of a strong dollar last year when the BOJ intervened in September and October of 2022. Those included hawkish central bank policy, higher energy prices, for an energy importer like Japan. Those higher energy prices combined with a weaker currency really increase energy costs for importers of oil, including Japan. And you also had relative yields moving pretty clearly in favor of the dollar because, as mentioned, changes in monetary policy and hawkish central bank policy out of the U.S. And so there are certainly parallels. It's one of the reasons why we'd like to think about the current environment as almost a US exceptionalism 2.0 style environment where relative growth, relative yields, and until very recently, energy prices seem to be pushing in favor of US growth over sort of ex-US growth, growth outside of the US. So I think there are a lot of fundamental parallels between the two experiences. One thing we can say, as I mentioned, the scale of the move that we saw on Tuesday lower in dollar yen is not as large as the moves that we saw during confirmed intervention periods last year. Now there is a bit of there is some apples and oranges here that it was a bit, maybe a bit more unexpected that they intervened last year. This year we have the benefit of knowing because they intervened last year, the risk was arguably higher this time around. But the scale of the moves in dollar yen on days with confirmed intervention last year were closer to 3 to 4% lower, whereas this move was a decent way smaller than that. So that might suggest that the move that we saw was not necessarily outright intervention. We'll know for sure at the end of the month. We know that the Bank of Japan announces, the Ministry of Finance and Bank of Japan, they announce the amount of FX intervention they do on a given month at the end of each month. So we would have to wait a long time for that official confirmation. The officials from Japan have kept it pretty close to the vest whether or not they intervened. They neither confirmed nor denied intervention. So if we also look back to 2022, there were media reports suggesting that the Bank of Japan did a rate check in the market before intervening in September of 2022 as well. So if you go back in local media, there were reports of a rate check around 10 days before actual intervention took place. So September 12th, more or less, or around that area, you had a rate check. September 22nd was when you had confirmed FX intervention for the first time in that intervention period. And so think about the almost playbook in the build up to intervention. Rate check is maybe something that comes along the way as you prepare for intervention. So certainly a lot of parallels a lot of parallels between this period and where we were last year when the Bank of Japan was considering and then ultimately opted to intervene in the currency market.
And I guess, local FX weakness is not just a problem for Japan. I think all, currencies, especially actually in the emerging market space, are really feeling the brunt and the pain of a resurgent dollar that just continues to gain stronger. And then obviously one of the big drivers that is, as he said, that sell-off of US Treasuries, particularly in the back end, really driving those yields higher. And in this speculation, it's driven by, reserve managers who are selling those assets. What do you feel are kind of the big forces behind just this significant multi-year rise in US yields?
Yeah, so like you mentioned, the move higher in the dollar broadly, not just against the yen, really has its base in these big moves in yield. And I think the expectation in the market, certainly as recently as a few weeks ago, was that the end of the Fed cycle would bring with it a relaxation of these dramatic upside moves in US rates. And that appears to be the case in the front end. But we have seen pressure has really just filtered out the curve, that as the market has seen stronger economic data in the US, you've just seen, instead of front end yield seeing the brunt of upside pressure, instead that has moved further out the curve, and you've seen long bond yields, 30-year yields in particular, have come under pretty significant upside pressure recently. I think there are a lot of different potential drivers for this, among them the Federal Reserve talking about higher for longer related risks. But one of the ones that I think gets a lot of attention is the possibility that foreign reserve managers need to sell Treasury securities in order to fund these interventions. So a bit of a catch-22 for the Bank of Japan, where we talk about a driver of dollar yen higher, weaker currency in Japan, is these higher US rates. If the way they want to combat that is to sell their dollar asset, their treasuries, and to use that dollar funding to buy their own local currency, then they may simply be exacerbating the downside pressure on treasury bonds, upside pressure on US yields. And so there's a bit of a catch-22 here for these central banks that are engaging in this type of strategy. Now, I think the question about the connection between FX intervention activity and weakness in long-term yields in particular, that link to me feels a bit tenuous, especially for Japan, for a couple of reasons. The first one is we would expect intervention activity, if there were to be selling of treasuries, is probably more likely to be done further in on the curve rather than in the long bond where duration risks are higher. A second point to make here is that the BOJ and currency reserves that are held and used at the BOJ on behalf of the Ministry of Finance, they have a portfolio of assets that they already deem as ready to use for intervention. So the BOJ notes that among the FX reserve holdings of Japan, there's about $135 billion worth of those reserves that are held in short-term deposits or securities of less than 1 year or on deposit at foreign central banks. So, custody holdings at the Fed, that includes a wide array of foreign asset managers. That almost certainly includes BOJ holdings of dollars as well. And so when the Bank of Japan comes in and intervenes in FX markets, they have a portfolio of ready-to-use intervention funds that they save specifically for this purpose. So this idea that they have to come out and aggressively sell long-term treasuries in order to fund intervention just doesn't really pass the smell test, because they have over 130 billion in ready-to-use funds for intervention. If you go back to last year, the size of the interventions that we saw was more than covered by the amount of short-term assets held by the MOF. So it was certainly, if interventions are on the scale of last year's interventions, then the ready-to-use funds certainly have enough. There's enough dry powder, there's enough ammunition to take on those kinds of interventions without actively selling treasuries. But it's important to note that as you look back at last year, that accounts, those funds did not change materially during September and October when the BOJ confirmed intervention. So that's been held at around 130 billion throughout that period, and it's really held very steady at that level since that time. So we only have monthly snapshots. So it's certainly possible that if intervention took place in the middle of September, by the end of the month, it's possible that account was replenished if it was the one that was used. But it's important to note that the BOJ has this, they have reserves on hand that are in very short-term securities or simply on deposit at foreign central banks that they tell us is what they would use in the case of intervention. But last year, there was very little evidence that that was the cash that was actually drawn down to use intervention. So you can't rule out this possibility of this sort of self-fulfilling prophecy where the market's looking at foreign reserve managers selling treasuries to increase the value of their currencies, perhaps worsening some of the interest rate and fundamental dynamics driving this weakness. So very interesting. We'll see later this week, we'll see the deposits at the Fed, the custody holdings of the Fed. That'll be a super interesting one to see if that shows any material change. That might be a sign of whether or not there was actual intervention this week or not.
It's generally kind of accepted wisdom that, it works better if your currency is actually undervalued. So I have to ask the big question, do you actually think that the Japanese yen at these levels is fundamentally undervalued?
Our own short-term fair value estimate for dollar yen at the moment of intervention was around 148.50 compared to 150 levels. So that's not a massive misvaluation in the market. And our fair value estimate was ticking higher alongside the move higher in dollar yen. And the big driver of that was these interest rate differentials. As I mentioned, the Bank of Japan has made some important changes to policy, their yield curve control policy. They've introduced this flexible yield curve control, which allowed their 10-year yield to trade higher with an implied cap of closer to 1% rather than 0.5%. There have been some hawkish changes made and perhaps signaled by the Bank of Japan, but interest rate differentials are still being driven by what's happening offshore, and these steady rises in interest rates in the US and in other economies as this hawkish central bank pricing, the sort of higher for longer, higher forever type mentality, that's been driving interest rate differentials to continue to move against the yen. Excuse me. And that has been one of the biggest fundamental drivers of yen weakness. And so these interest rate differentials haven't exactly been moving in the other direction. As you mentioned, Eimear, I think this is the right way to think about FX intervention, is that it's most effective when there's a move in the currency that's happening against the sort of fundamentals. We didn't exactly see that happening in this case. And, as we've argued in the past in this space on this podcast, that I don't think there's anything particularly special about 150 in terms of this is a level that must be defended, simply because the fundamentals aren't screaming that 150 is so far out of line with where interest rate differentials are telling you the dollar yen fair value may be. There's also other issues to consider as well when you think about fundamental valuation. As I mentioned, oil prices have been moving higher alongside the dollar. So oil prices denominated in yen, those have moved higher. So as a large oil and energy importers in Japan, the demand for dollars increases as oil prices rise and the local currency weakens. And so there is certainly a potential flow aspect. Earlier in the summer, we had seen very big foreign inflows into Japanese equity markets. Those have recently reversed. Now we're seeing net outflows on balance. If you look at, say, a 12-week rolling sum, for example. And so there are other fundamental drivers. It's not just a rate story, although interest rate differentials do tend to do a lot of the heavy lifting when it comes to dollar yen. So, as we had argued in the past and continue to argue now, the fundamentals aren't exactly screaming that the currency is sharply undervalued to a point where FX intervention is really required. But look, our definition of what counts as undervalued or what counts as an excessive move and what the MOF in Japan or what the Bank of Japan considers an undervaluation can obviously be very different. And, I think what the move this week has done is whether this was intervention or not, whether this was a rate check or not, or whether Bank of Japan and MOF were involved at all in this big move, is it increases the importance of 150, the level of 150 in the market. That if the price action in dollar yen was primarily one way, the dollar was generally rising against the yen, this creates, I think, a little bit more two-way risk in the yen. We know from a positioning perspective, we think the market is quite short yen. CTA, momentum-related signals were mostly pointing in the bearish direction in our assessment. So from a positioning perspective, from a momentum perspective, the authorities there might be thinking that this is a bit maybe out of line with fundamentals, that the positioning is a little bit too much one way, that the momentum is a little too consistent one way. That could be an argument for intervention. But from a relative rate perspective, from a fundamental drivers perspective, it's not obvious that the move is so far out of line that intervention is going to be the linchpin to a turnaround in the yen, for example.
That being said, what would be the linchpin for turnaround in the yen? It has been very weak. It's lost, over 12% against the dollar year to date. What could trigger a reversal and bring back some currency strength?
We've talked a lot about interest rate differentials as a big driver of not just the dollar yen, but the broad dollar. And it feels like the global policy cycle turning is really the biggest potential driver of yen recovery. So interest rate differentials are being primarily driven by what's happening outside of Japan rather than inside of Japan. And to the extent that global central banks have been suggesting and signaling that they will continue to raise rates and they will leave rates very high for longer than the market is currently pricing, or leave rates on hold for as long as necessary, right? That differential, that global policy cycle, that very, very hawkish signaling from central banks is the biggest driver of this policy divergence, where Japan has left policy rates extremely accommodative. The growth outlook has improved in Japan. Inflation is higher. The risk of Japan having to tighten policy is better now than it has been any time in the last several decades. That's certainly true. But the biggest driver of this relative differential is what's going on in the global policy cycle. Now, we are coming up to a point here where most central banks are either close to done with their policy tightening cycles or at their, what we suspect is their terminal rate. So for the Fed, it's possible you get one more hike this year. That's what most of the Fed members projected in their dot plot back in September. A number of other central banks we think are at the point of the peak in the cycle. So we seem to be moving towards a period where instead of active tightening of monetary policy via rate hikes, we're heading towards a more passive stage of tightening where policy rates being left at high levels in combination with quantitative tightening, running down of balance sheets in a lot of cases, are doing more of the heavy lifting in terms of policy. So in this environment, you may start to see lower upside pressure on rates, and eventually this pressure starts to change as pause cycles eventually beget easing cycles. And so I think this is the big question in not just dollar yen, but in global financial markets, which is at what point do we mark these transition points? I think it's pretty clear that earlier in the year, when many, including ourselves, were expecting the policy cycles to end much sooner than they have, we've been surprised in the hawkish direction. We've been surprised by the resiliency of U.S. data in particular. But we continue to think the U.S. economy slows into 2024, and that ultimately a pause begets an easing cycle by the Fed, or at least the beginning of the easing cycle, in sort of late first half of next year. So that change in the policy cycle is probably the most important potential game changer for the yen. And at least in our perspective, we do think that there's long-term value in positioning for yen recovery on that basis. Perhaps not against the dollar, where interest rates are very, very high, so there's punitive carry. But one that's very interesting is the Swiss franc, which is a currency where inflation is quite low relative to many of its peers. Its nominal policy rate is very low, and they've been very successful in containing inflation, thanks in part to their foreign reserve sales to support their own currency. So because, for example, inflation has been lower, they've been successful in containing inflation, we think there's probably some ability for that central bank to slow down their tightening and eventually slow their FX activity. And that's just an example of one change in the global policy cycle where we think the yen can find support. So that, to me, I think is the most important driver. FX intervention alone is probably not enough to change the fundamental backdrop. What's more important is, when does this cycle shift away from active tightening to passive tightening and then eventually to active easing? The timing of that cycle, the duration, how quickly can that come up? Those are all the big factors that I think are critical to assessing how much longer the yen stays weak and when it can eventually start to turn the corner.
Yeah, I think Japan is yet another economy which is really at the mercy of the US Federal Reserve policy. Probably FX intervention would do very little, and it would be kind of a temporary sticking plaster. Brian, thank you so much for joining us this week and taking us through everything. That's probably about all we have time for this week. Do remember to click like and remember to subscribe so you get the latest episodes first. Thanks again for joining us. Goodbye.